Hello students, today I am going to discuss a chapter in that is ratio analysis of class 12 uh, CBSE accountancy, and this ratio chapter has got very less weightage in the paper, so I thought of making a video which will cover major points of the chapter so that you can do a quick revision of the chapter. So let us start with the first ratio. First ratio is liquidity or short term solvency ratio. Liquidity ratio, there are two types or two ratios, that is current ratio and another is liquid ratio, or it is also called as quick ratio or acid test ratio. These are the two liquidity or short term solvency ratio. So first, current ratio is calculated as, from the name itself you can guess, the current ratio is current assets by current liabilities, and this ratio is calculated, from the name itself you can also say that liquid assets or quick assets by current liabilities. So first of all, we should know what are the current assets. Okay, so there is a definition for the current assets given in our book, that is, current assets are those assets either in form of cash and cash equivalents or can be converted into cash and cash equivalents within 12 months from the date of balance sheet or within a period of operating cycle. So those assets which can be converted into cash and cash equivalents within 12 months period are called as current asset, or within the operating cycle. So if the operating cycle is beyond a period of 12 months, then that complete period, if an asset can be converted within that period, then it will be called as current asset, even if it is beyond 12 months. If nothing is mentioned, then operating cycle will be taken as a period of 12 months. So what are the current assets? So for calculating this ratio, we need numerator current assets, denominator current liabilities. So if you remember the balance sheet, in our balance sheet which we learned in 11th, because 11th we had only sole proprietorship for study. So in that balance sheet we used to have fixed assets and current assets. So fixed assets are all those tangible fixed assets like building, machinery, etc. And current assets included other things like sundry debtors, bills receivable, cash and cash equivalents, outstanding income. All these things which were below this heading, current assets, will be taken as current assets for our calculation. And except they are giving two exceptions for this: loose tools and spare parts. Loose tools and spare parts will not be considered in calculation of these current assets. So the definition of current assets given in book is, current assets, as I read already, they include current investment, short term investments and marketable securities, inventories excluding loose tools and spare parts, trade receivables, bills receivable and sundry debtors, less provision for doubtful debt. So there will be current assets, there will be sundry debtors. We will take those current assets excluding after deducting provision for doubtful debts. then cash and cash equivalents, short-term loans and advances, other current assets. So basically all those things which come under this head except loose tools and spare parts. So these things are included in current assets. So we got the numerator, then we will have to look for the denominator. Denominator is current liabilities. So current liabilities are, if we see the balance sheet, there is capital and there are creditors like long-term borrowings, long-term provisions, and then short-term provisions. All short-term things will come like short-term borrowing, short-term provisions, sundry creditors, bills payable. All these things will come below the capital, that is long-term commitment, long-term debts. So those everything will be included in current liabilities. So we'll read the book definition. Current liabilities are the liabilities repayable within 12 months from the date of balance sheet or within a period of operating cycle. They are shown under the head current liabilities in the balance sheet. So those which are repayable within a period of 12 months from the date of balance sheet or within the operating cycle, they are called as current liabilities, and they include short-term borrowings, trade payables, other current liabilities, that is current maturities of long-term debts, interest accrued but not due on borrowings, interest accrued and due on borrowings, outstanding expenses, unclaimed dividend, calls in advance, etc., and short-term provisions. So basically short-term borrowings, trade payables and short-term provisions. So these things are basically required for our calculation, and they are used mostly for the calculation. So just for our information, what is operating cycle? It is given in the book. An operating cycle is a time between the acquisition of the assets or processing or assets for processing and their realization into cash and cash equivalents. When normal operating cycle cannot be identified, it is assumed to be period of 12 months. That's it. So ideal current ratio is 2:1. So it is ideal to have current assets double of that current liabilities. Okay. So and another thing is objective and significance. The objective of calculating current ratio is to assess the ability of enterprise to meet its short-term financial obligations. So for meeting all these short-term liabilities, short-term debts, whether the short-term assets are sufficient for the enterprise. So this is what is the aim of calculating this current ratio. Okay, so there are some questions in the book. They have given some questions like whether the current ratio will increase, decrease, or it will not change. So let us have a look on those questions. So in the questions, when they ask whether the current ratio will improve or it will reduce or it will not change, what is required to be done is you have to assume the figures according to the given ratio. So let us refer to book page number 4.12, illustration 15, book 2022 edition. Illustration 15. Current ratio of company is 2:1. State giving reasons which of the following would improve, reduce and not change the ratio. So current ratio is 2:1. So we will assume current assets is equal to 2 lakhs and current liability is equal to 1 lakh. So current ratio is 2:1. So this is the first step. Then I will just explain the important problems in this. All others are similar. In all such type of problems, try to form a journal entry so that which account is getting debited and credited, you will get to know, and with that you will also get to know whether current assets or current liabilities are increasing or decreasing. So second case, purchase of goods for cash. So purchase of goods for cash means what is the ratio? Purchase of goods for cash means purchase account debit to cash account. Okay, so goods here, purchases account debit to cash account, or goods here we will call as stock. So the entry is stock account debit to cash. Okay, so no liability is there, only the current assets are there. So stock is increasing, cash is reducing. So in case if this is purchase of goods for cash, it is for 50,000. So stock 50,000 and cash 50,000. So this current assets will increase by 50,000. It will become 2,50,000 and cash is going out. So current asset will decrease by 50,000. So ultimate effect to the current assets will be nil. So the ratio will not change. Then third case in this, sale of office equipment for 20,000, book value 25,000. Yeah, in this case, sale of office equipment for 20,000, book value 25,000 means we are selling an office equipment and the company is getting 20,000 as a cash. So the entry will be cash account debit 20,000 and office equipment has gone from our books of 25,000. So this is P&L, that is loss on sale is 5,000. So out of this, office equipment is not included in current assets, not in current liabilities. P&L is nowhere included. Only cash is included in current assets. So cash is coming in. So 20,000 is increasing. So this numerator will increase by 20,000. So it will become 2,20,000 by 1 lakh. So the ratio will become 2.20:1. So ratio is improving. Ratio will improve. Yeah. Then sixth case in the same problem, payment of declared dividend. So declared dividend, payment of that particular dividend, it has to be paid within a period of 30 days. Once the dividend is declared, it has to be paid within a period of 30 days. So it is definitely a current liability. So it is like outstanding liability which has to be paid. So that outstanding liability must have been appearing in the balance sheet as outstanding liability under the head current liabilities. So that outstanding liability will go. So the entry will be outstanding liability, that is dividend account debit to cash. So if that is 50,000, so 50,000. So this is the entry. So outstanding liability is current liability. So current liability we are giving debit. So current liability will get reduced by 50,000. So this will become 50,000 for this sixth case, and the cash is also going out. So current assets are also getting reduced. So the cash will become 1,50,000. Okay. So what is happening to the ratio in this case? Ratio is becoming 3:1. So we will say ratio is improving. Okay. Now come to illustration 16. First case, redemption of debentures. So you have to assume if there is in the problem, if they give you redemption of debentures, means those debentures are redeemable. They are redeemable means they are current liabilities. They are redeemable within a period of 12 months. So redemption of debentures means debentures we have to buy back. So we have to repay, we have to pay the cash and we will get back the debentures. So debentures amount will get reduced and cash will also get reduced. So if we assume the same thing here, if the redemption of debentures is for 50,000, so the entry will be debentures account debit to cash. So if this is again 50,000, we are going to get the same ratio, that is 1,50,000 by 50,000. Okay, so the ratio will improve. So whenever it is given that redemption of debentures, you have to assume that debentures are current liabilities and you have to give effect to current liabilities. Purchase of loose tools against cash. First of all, loose tools are not a part of the current assets. So purchase of loose tools. What is the entry? Loose tools account debit to cash. Okay, so if it is for 10,000, so loose tools is not a part of current asset, but cash is going. So if the loose tools are 10,000, cash is going. So this will become 1,80,000 by 1 lakh. 1,90,000 by 1 lakh. So ratio will become 1.9:1. Okay. So 1.9:1, it means ratio is reducing. Okay, so these are some peculiar cases which has to be studied. Let us come to illustration 20. Illustration 20, case 3. Bills receivable endorsed to a creditor. Bills receivable endorsed to a creditor. So if we go back to class 11, we have studied bills of exchange. So in that case, payer and payee. So payer is a person to whom the money has to be paid, and payee is the person who has to pay money. So for him, bills receivable is an asset. So when the bills receivable bill is drawn and accepted, so he will pass entry bills receivable account debit to payee, and he will pass entry payer account debit to bills payable. For him, bills payable is a liability. So bills receivable endorsed to a creditor means this payer has given this bills receivable to his creditor. Means now what is happening? He has to pay to his creditor and he has to receive. Here there is a creditor. So payer has to pay to creditor and payee has to pay to payer. So what he is doing, idea, he is endorsing that bill in favor of creditor so that payee will pay to creditor directly. Now he is not involved. Anyways, he has to pay to him, so he asked payee to pay to him. So he has endorsed the bill. So what entry he will pass? This is just a entry of endorsing that bills receivable in favor of the creditor. So now this bills receivable has to be removed from his books. So for this debit, we will create a credit to bills receivable account, and to whom he has paid, he has given that bill to creditor. It means he can assume that he will pay to him so that his creditor balance will get reduced, his liability will get reduced. So we have to debit the creditor account. Creditor account. So this is the case. So payee is expected to pay to the creditor. So creditor account debit to bills receivable. So now what is happening? So in this case, both the creditor and bills receivable. Creditor is part of current liability and bills receivable is a part of current liability. So we'll just take the first case, that is 1:1. It means the current assets and current liabilities are same, 2 lakhs and 2 lakhs, 1:1. So in this case, what will happen? If this is 50,000, it will again become 50,000 and 50,000. There will not be any change. They have also given a second case, that is 0.8:1. So if we assume this is 80,000 by 1 lakh, and if this is 10,000, okay, so this will become 70,000 is to 90,000. So what will be the ratio now? 7 divided by 9. So it will become 0.77. Obviously the ratio will reduce. So if the numerator and denominator are same and the amount to be added or deducted from both the numerator and denominator is also same, the ratio will remain unchanged. But if the numerator and denominator figures are different and the same amount has to be deducted or added from the ratio, then ratio will change. So in this case, you have to actually calculate the ratio and see. Okay, in continuation to that, bills receivable endorsed to creditor dishonor. This bills receivable which this payer has endorsed in favor of creditor is dishonored. Means this payee didn't pay to creditor. So it becomes duty of the payer to pay to the creditor. Okay, so now everything got cancelled. So again the same entry, same situation came back. So again he has to revise or reverse the entry. So the same entry he will pass, he will reverse the entry. Bills receivable account debit to payee. Okay, bills receivable account debit to creditor. So he has reversed this entry because now he has to pay to the creditor, and anyways he has to pay to him because this is already there. He has to pay to him. Okay, so bills receivable to creditor. So again the same thing has happened. So creditors will increase and bills receivable will creditors will increase and bills receivable will also increase. So in this case also the ratio will not change because in this case bills receivable is increasing. So if it is 2 lakh is to 2 lakh and it is 10,000, so 2 lakh 10,000 by 2 lakh 10,000 it will be same. In case of 80,000 by 1 lakh and this is 10,000, so this will become 90,000 and this will become 1 lakh 10,000. So now what is happening to the ratio? 90,000 divided by 110. So it is becoming 1.81. So anyways the ratio is reducing in this case. Okay, so these are some difficult cases which has to be studied. Then case H, in this case sale of goods for 25,000 cost 20,000. Sale of goods for 25,000 cost 20,000. In this case what entry we are going to pass? We are getting a cash. We are getting cash of 25,000. So definitely cash account debit 25,000. Okay, and the goods which are going from the business stock account 20,000 and we are getting profit to P&L account 5,000 is the profit. So cash will increase by 25,000. It means current asset increase by 25,000. Stock is reducing by 20,000. It means current asset will get reduced by 20,000. So ultimate effect is current asset only is increasing by 5,000. So in the first case 2 lakh 5,000 by 2 lakh. So ratio is definitely going to improve. In this case, the second case was 80,000 is to 1 lakh. So in this case definitely there is a difference, but it is not improving by that amount. So it will become 85,000 is to 1 lakh. So the ratio is going to the ratio is going to be 85,000 by 1 lakh. So in this case previous ratio was 0.8 is to 1 and now it will become 0.85 is to 1. So the ratio is improving. So remember we have to do the comparison this ratio with that ratio only. Don't do comparison this ratio and this ratio. Okay, so these are two different situations they have given. So similar will be the case in case of the loss. So according to journal entry you have to see what is happening to the ratio. Now let us come to second ratio, that is liquid ratio or quick ratio or acid test ratio. So the formula for that is liquid assets by current liabilities. So current liabilities is the same which we discussed previously. The formula for liquid ratio is liquid assets by current liabilities. So liquid assets are same as that of current assets but excluding inventories. So in current asset we used to take inventories excluding loose tools and spare parts, but in liquid assets we will not at all take inventories. So not loose tools, spare parts, nothing, no inventories will be taken in case of liquid assets. Similarly prepaid expenses will not be considered. So inventories and prepaid expenses are excluded. If you go to current assets, other current assets, prepaid expenses, interest receivable, etc. So prepaid expenses were included in the portion other current assets. So but in case of liquid assets, inventories total are excluded. So inventories will not be included, and loose tools, that is why loose tools and spare parts will not be included, and prepaid expenses will not be included. So in such a manner we have to calculate the liquid assets and current liabilities. So let us go to page number 4.21 of the book. Illustration 33. Quick ratio of company is 1.7 is to 1. State giving reason which will increase, will improve, reduce or no change. Sale of goods we'll take the first case, purchase of inventory for cash. Purchase of inventory for cash. First of all, you have to remember we are calculating quick ratio. In quick ratio, inventory is not included. Okay, so purchase of inventory for cash. What is the entry for that? Entry is inventory account debit to cash. So inventory is a part of current asset, but it is not a part of current or quick liability. Quick assets. So inventory will not be considered. So the entry is inventory account debit to cash. Okay, they have not given any amount. So let us assume quick assets are 1,70,000 divided by 1 lakh. Quick assets are this and current liability is this. So inventory is not a part of current assets. So only cash is reducing. So this inventory is reducing. So what will happen in this case? So the ratio will, if this 1.7 is to 1. Okay, so the previously the ratio is 1.7 is to 1. So now if this is purchase of 20,000, it will become 1,50,000 is to 1. So the ratio will become 1.5 is to 1. So the ratio is reducing. Third case, sale of goods costing 10,000 for 60,000. So we are getting cash account debit 60,000. Okay, to stock 10,000 and to P&L, that is profit of 50,000. So cash is improving, so quick assets will improve, and stock anyways it is not considered, and P&L it is not considered. So if this is 60,000, so cash will improve by 60,000, so it will become 2,30,000 by 1 lakh. So the ratio is definitely going to improve. Okay, then come to illustration 35. So quick ratio of a company is 1 is to 1. So we can assume 1 lakh by 1 lakh. So first case, paid insurance premium in advance. So what is the entry for that? Paid insurance premium. Insurance premium is paid. So definitely cash account is going to be credited. So debit is advance insurance premium to cash. Okay. So if this is, they have given the amount, that is 10,000. So from 1 lakh it will become advance insurance premium is not a part of quick asset. So only cash will go from the quick asset. So quick assets will get reduced by 10,000. So in this case our ratio will become 90,000 by 1 lakh. So the ratio will decrease. Third case, issued fully paid equity shares of 1 lakh. Issued fully paid equity shares of 1 lakh. So it will become cash account debit to equity shares account. So cash is increasing. Equity share is not a part of quick asset or current liabilities. So cash effect will give to quick assets. So quick assets will increase by 1 lakh. So the ratio will become 2 lakh by 1 lakh. So 2 is to 1. So ratio will improve. Then fourth case, issued 9% debentures of 5 lakhs to vendor for machinery purchase. We are purchasing machinery, so machinery is coming in. So machinery account debit to 9% debenture account. Machinery account debit to 9% debenture account. So machinery is not a part of quick asset. Okay. 9% debenture is not a part of current liability. So no effect will be given to the ratio. Nothing is mentioned about debenture, so we'll assume it as a long term. So there is no change in the ratio. So these are some cases to be discussed, and there are few problems which has the balance sheet, but when we see the balance sheet we feel it is a difficult problem, but it is a very easy problem because the figures are in front of us and it is easy to calculate. So in this illustration there are few formulas which are used. If we do the illustrations, it covers basically the complete things which are given in exercises of T.S. Garewal book. So there is one formula used, that is working capital is equal to current assets minus current liabilities. So this formula is used in some of the places. So if working capital is given, then we can find out the ratio will be given for between current assets and current liabilities. Maybe it is twice current liability is half of current asset, like that. So in those cases you have to form an equation and find out the amount. So if we know any one of them, we can find out the amount. Then sometimes we have been given total debts and long term debts. So from total debts, if we deduct the long term debts, we will get the current liabilities. Similarly, from total assets, if we deduct the fixed assets, we will get the current assets. So these things, anyhow, you have to find out the amount of current assets and current liabilities. There is one illustration on page number 4.11, illustration 13. So this is a little different illustration. So let us have a look. All the illustrations which are given before this, in those illustrations you have to somehow find out the amount of current assets and current liabilities, or maybe in case of quick ratio, quick assets and current liabilities, you have to find out those assets from the given information. So what is this illustration 13? Ratio of current assets is ratio of current assets to current liability. Ratio of current assets to current liability is 4, that is current assets 6 lakhs and current liabilities is 4 lakhs. The accountant of firm is interested in maintaining current ratio 2:1 by paying part of current liabilities. Compute the amount of current liabilities that should be paid so that current ratio at level of 2:1 may be maintained. So what they are saying, current assets are 6 lakhs before, okay, and current liabilities are 4 lakhs. Okay, so the ratio is 1.5 is to 1. 1.5 is to 1. Now they want to maintain this ratio as 2:1. So 2:1. So by paying some form of current liabilities, the ratio should be this. So if they pay off current liabilities, okay, so by paying off some current liabilities, so the entry will be, if they are paying off creditors account debit to cash account, this will be the entry. So the current liability will get reduced and cash will also get reduced. Okay, so in this example, from this, if that particular amount to be deducted, to be repaid, is assumed to be X, so creditors are getting reduced by giving debit X by X amount, and cash is going out, so that is also getting reduced by X amount, is equal to 2:1. So this equation is formed, cross multiplication, and you have to find out the value of X. So this is some different type of illustration. Okay, on the basis of some formulas, let us have a look on two problems, and this will be easy when we study debt to equity ratio, because there is a complete balance sheet format which I am going to give you in debt to equity ratio, so that all these calculations will become easier. So come to page number 4.97 of T.S. Garewal book, and problem number 26. Working capital of the company is 3,60,000 and the total debts are 7,80,000 and long term debts are 6 lakhs. Okay, and inventories are 1,80,000. So first thing is, we know working capital is equal to current assets minus current liability. So working capital they have given 3,60,000 is equal to, okay, total debts means total of the debts payable minus long term debts. So if we deduct from long term debts from total debts, we will get current liabilities, that is short term debts. So this is becoming 1,80,000. So current liability is 1,80,000. So current assets will become x is equal to 360 plus 1,80,000. So it will become 5,40,000. So current asset became 5,40,000 divided by current liability, that is 1,80,000, will give you the current ratio divided by 1,80,000. So current ratio is 3:1. So these formulas has to be remembered. So the key start point is total debts minus long term debt will give you current liability. Okay. So and working capital formula. Another example which I wanted to discuss is exercise problem 31. Total assets are 11 lakhs. Fixed assets are 5 lakhs. So from this formula you can know the current assets are how much? Current assets are 6 lakhs. Okay. Then capital employed is 10 lakh. So capital employed is, so if you want to know the formula of capital employed is capital employed is equal to debt plus equity. Okay. So capital employed is debt plus equity. So total debt less equity. Oh, total debt plus equity will give you capital employed. Okay. So capital employed, total debt plus equity plus current liabilities, because this total debt means only long term debt. Okay. So long term, I will to be more precise, long term debt plus equity will give you capital employed. But there is another thing in the liability side which is current liability. Okay. And the total of both balance sheet liability side and equity and asset side should match. So what all we have here? We have capital employed. Capital employed, this is liability side. What is the capital employed? It is 10 lakhs. And in the another side we have total assets. Total assets are 11 lakhs. Okay. So there is total assets means full fixed assets plus current assets. So there is nothing left in the asset side. So the liability side total should also be 11 lakhs. So something is missing. What is that missing portion? Is current liability. Current liability is 1 lakh, because capital employed is long term debt plus equity. So this is only long term debt plus equity. So definitely current liability portion is missing. So now from this you got 1 lakh as current liability, and you know current assets are 6 lakhs. So the ratio is 6:1. So these are all the formulas which are useful for calculating current ratio or quick ratio. To be more precise on the formulas related to balance sheet for calculating quick assets, current liabilities from the balance sheet, we will be able to find out this with more precision after we study debt to equity ratio. So let us meet in my next video for debt to equity ratio. Thank you.